Shaken, not stirred, a closing bell that sees us closing on the markets. We're going to settle roughly. The Dow is going to be up 424 points. The S&P 500 is going to be up roughly 40 points, and the Nasdaq is going to be up 132 points. Again, the Dow crossed 32,000 today. Also, sectors, want to mention, as Inez was pointing out, energy sector up 3.5%. Oil at $63 a barrel. I want to bring back our guests and hit you with this, Matthew, because you are Deutsche Bank's chief U.S. economist. Been quoting Deutsche Bank research in my most recent articles on airlines. But I got to ask you, oil at $63 and going higher, does that threaten the recovery in the United States or globally?
No, I don't think so at all. I think it's reflecting a pickup in demand that we're expecting to see. We just recently upgraded our U.S. growth forecast to 7.5% this year, expecting that you get a fiscal stimulus package around 1.6 or 1.7 trillion. I don't think that rising oil prices, rising gasoline prices are going to undermine that. We see households with very high savings rates. They're going to get a further fiscal infusion in the coming months. As the economy reopens, we'll be adding robustly new jobs to the economy. And I don't think that that's going to be undermined simply by the move higher in oil that we've seen recently.
Well, Matthew, what about what we're seeing going on in the jobs market? Because that's one area of the economy that has started to lag a little bit. When you take a look at some of the numbers that we've gotten in recent weeks when it comes to jobless claims, the number that we're expecting to get tomorrow still above 800,000. Does that cause you any concern?
The jobless claims data has definitely been the one area of disappointment and concern that we've seen recently. Now, there's been difficulties when interpreting that data, certainly with seasonal adjustment issues, some backlogs that we've seen. And so I think it's less reliable of an indicator of the real-time economy and labor market than we've seen in the past. I think really notably, last week in the monetary policy report that the Fed put out, they showed some high-frequency data for the employment side, and it actually began to rebound pretty meaningfully in late January and then early February. I think really as the economy begins to reopen more, as vaccines continue apace, and as this fiscal stimulus comes online, we will be seeing substantially better jobs data over the next several months.
Doug, you were a bouncer at a nightclub. I was the 16-year-old with the fake ID that said I was 78, not a good idea. Help me understand, because that was bad then, why bonds, I think you said bonds are still attractive with 18 trillion in negative yielding debt. Why is that a good idea?
Well, actually, the sort of bouncer analogy was that the guest list for the market party in 2021 is going to be a lot more inclusive than the guest list for 2020. Bonds, I'm not a big fan of. If we had to sort of rank asset classes, I'd have U.S. equity at the top. I'd have emerging markets as number 2. The rest of the developed international space at number 3. And a distant fourth would be bonds. I think if you have to own bonds, I think U.S. investment grade would be the way to go, because you are getting a pickup. You're sort of keeping up with inflation. And at the end of the day, all other bonds look even worse.
Matthew, I want to get your thoughts on the consumer, because it's interesting what we've seen when we take a look at the data that we've gotten over the last several months. Because when you take a look at it, the consumer's outlook on the economy has pretty much been flat, that consumer confidence number that we just got out. But when you take a look at what the market is anticipating, what investors are anticipating, that part of the equation has improved dramatically. How are you balancing that?
Yeah, I think that it's a really difficult balancing act, and it's certainly a difficult balancing act from the Fed's perspective. The comments that we got from Chair Powell over the past 2 days, Vice Chair Clarida today, Governor Brainerd, all skewed to the dovish side, noting that we haven't seen all that much progress in the labor market recently. We've had some mixed data, even though they did note that in the future we may be able to pick up in terms of economic activity. From our perspective, the weakness that we saw in the data and in Q4, particularly with retail sales, was to be expected in an economy that was seeing the largest wave for the COVID shock. Hospitalizations were hitting peaks. We saw a return of these restrictions that took place, and it just very naturally, I think, impacted consumer spending. I think we have a very different dynamic over the next several months. We have, again, additional fiscal stimulus coming online. We've seen the COVID wave receding, vaccines picking up, reopening is going to pick up. And all of that, I think, should lead to a very supportive dynamic for consumer spending over the rest of the year.
All right, we want to get to some breaking news. We have earnings results out from Booking Holdings. Emily McCormick has the numbers for us. Emily?
Sean, we're taking a look here at Booking Holdings actually beating expectations just slightly on the top line for fourth quarter results, but still posting massive year-over-year declines as we've seen the coronavirus pandemic continue to exert pressure on the travel industry. Now, we saw fourth quarter revenue coming in at $1.24 billion. That was just modestly above the $1.2 billion that had been expected, and that figure was down 63% year over year. And this is the fourth straight quarter that we've seen those year-over-year declines in sales for Booking Holdings. Now, on the bottom line, we had adjusted EBITDA losses coming in at $38 million. That was narrower than the losses of $41.7 million that had been expected, but again, swinging to a quarterly loss from a profit in the year ago period. Now, I want to highlight some comments here from CEO Glenn Fogel. He said, quote, "The travel environment continued to be challenging through the fourth quarter of 2020 and into January 2021 as COVID-19 case counts remained very high and travel restrictions were reimposed in many parts of the world. However, in recent weeks, we have started to see some improvements in booking trends that we will continue to monitor. Looking ahead, I am more confident than ever in our long-term future and in the eventual strong recovery of travel demand," end quote. Now, taking a look here at these shares, we are seeing them popping by about 2.8% in late trading. So getting a bit of a pop here with that top and bottom line beat. Shauna and Adam.
Emily, thank you. I want to go back to Doug. Given what we're seeing with pent-up demand, are the travel-related stocks danger zone right now? Because we keep hearing analysts say they're undervalued, and now's the time to consider adding them to your portfolio.
Well, I think that was a great example, which is they've had a tough time, but everybody you talk to, I talked to somebody today, he said, I just got my vaccine and I'm getting on a plane. And I'm not just getting on a plane, but I'm going to do that splurge vacation that really makes up for the 2 or 3 vacations I skipped in 2020. So I think you're going to see a massive sort of pent-up demand in the travel and entertainment business. I think people are going to go to restaurants, they're going to take their friends to restaurants, and they're going to have sort of those blowout trips that they've been saving up for and thinking about for the last 12 months. So my guess is the industry comes back maybe a little more quickly than people think.
Matthew, you mentioned the fact that you raised your GDP forecast for the year. When it comes to getting back to those pre-pandemic levels, though, and pretty consistently, how long do you expect that to take?
So I would make a very big difference between economic activity and GDP and the labor market. We think you get back to pre-virus levels for GDP by next quarter, Q2. And in fact, with this fiscal stimulus, 1.6 to 1.7 trillion that we've built in, we think you get back to even the pre-virus growth path by late this year and into 2022, which is, I think, really a remarkable development given where we were just 6 months ago or so. I would contrast that with the labor market. You know, prior to COVID, we had a 3.5% unemployment rate, the lowest level in 50 years. It's going to take longer to get back to those types of unemployment readings. We think that's probably unlikely until the end of 2022. So there is this very different timeline, I think, for economic activity, consumer spending, GDP to recover, and a longer path to recovery for the labor market.
Matthew Luzzetti, Deutsche Bank's chief U.S. economist, and Doug Sandler, RiverFront Investment Group's head of global strategy. Thanks to you both for joining us today.